In our previous videos, we mastered the 9 and 21 EMA crossover for quick entries. But there's a common problem. How do you know if that crossover is a trap or a real trend? Today, we are introducing the big brother of all indicators, the 200-period Exponential Moving Average. If the 9 and 21 EMAs are your compass, the 200 EMA is your North Star. In this 4-minute guide, I'll show you why professional traders never trade against this line, and how you can use it to filter out 80% of losing trades. Let's dive in. What is the 200 EMA? So, what makes the 200 EMA so special? Simply put, it calculates the average price of the last 200 candles, giving more weight to the most recent data. Think of it as the institutional line. Big banks and hedge funds use this to determine the long-term bias. The rule is simple. If the price is above the 200 EMA, we are in a macro bullish trend. We only look for buy setups. If the price is below the 200 EMA, we are in a macro bearish trend. We only look for sell setups. By following this one rule, you stop fighting the market and start swimming with the tide. The strategy, the pullback entry. Now, let's talk about the strategy. We aren't just looking for the price to touch the 200 EMA. We are looking for the pullback. When the market is in a strong trend, the price often moves too far away from the 200 EMA when it eventually returns to touch or retest this line. The 200 EMA acts as a massive wall of support or resistance. Here is your entry checklist. Identify a clear distance between the price and the 200 EMA. Wait for the price to move back toward the line. Look for a rejection candle, like a pin bar or a bullish engulfing right at the EMA. Place your stop loss just behind the EMA line for a tight, protected risk. This turns the 200 EMA from just a line on a chart into a high-confluence bounce zone. Pro tip: combining with smaller EMA. To make this even more powerful, you can bring back our previous tools. Watch for the 9 and 21 EMA crossover only when it happens in the direction of the 200 EMA. If the 9 crosses above the 21, and both are above the 200 EMA, you have a triple threat signal. This is where the highest probability intraday moves happen. It ensures you aren't just catching a small bounce, but joining a massive market move. Conclusion and see: the 200 EMA is the difference between a gambler and a technical analyst. Add it to your charts today and see how many fakeouts you avoid. If you found this helpful, hit that like button and let me know in the comments which time frame you use for your EMA analysis. Happy trading!